Welcome, everyone. Thank you for joining us today on our webinar, Insurance Gaps, Covering the Things You Don't Consider. This webinar is presented as part of the Queensland Farmers Federation Farm Business Resilience Program and is jointly funded by the Australian Government's Future Drought Fund and Queensland Government's Drought and Climate Adaptation Program. My name's Beck Takal, and joining me today we have Russ Mehmet, Client Solutions Director, Corporate Risks and Brokering, and Michelle Love, Client Relationship Manager, Health and Benefits from Global Commercial Insurance Brokerage, Willis Towers Watson. We also have Bill Hardy, Senior Underwriter, Crisis Management and Weather at global insurer Liberty Specialty Markets. Russ has spent over 40 years in the insurance industry, both as an underwriter and broker. He joined WTW Brisbane in 2005 and has provided risk advisory and insurance brokering services to clients in a variety of industry sectors. For the past 6 years, Russ has worked closely with QFF on a number of agricultural specific research and adaptation projects, focusing on developing targeted and affordable products for Australian farmers. Russ will be covering the gaps and pitfalls often associated with and not considered with general insurance. Michelle has worked exclusively in the accident and health and employee benefits insurance market since 1997. Prior to joining WTW's health and benefits practice in 2011, Michelle was accident and health insurance manager at an international insurer for 14 years, managing a varied portfolio of accounts ranging from SMEs to large corporates. Michelle is a specialist in the area of group life products, personal accident, income protection, expatriate medical, and health and corporate travel. This expertise is developed from both an underwriting background as well as an employee benefit consultant perspective. We know farms can be dangerous places, so Michelle will help us identify some insurance tools that might offset the risks we can't mitigate. Bill began his career as a professional horticultural agronomist in the Wide Bay region of Queensland, so he has a deep understanding of the weather risks associated with the ag sector. After 8 years, he moved on to work as an agricultural reinsurance underwriter in Switzerland and Bermuda, managing treaty and parametric products throughout the US and the rest of the world. He joined Liberty as a senior underwriter for crisis management and weather in 2018. Bill's primary focus is on parametric product development and agricultural risks, and we look forward to him explaining the do's and don'ts of building a highly customizable parametric product. My colleague Julia Jergs is also joining us today to ensure we don't miss any questions you might have. We will try and answer any questions you have along the way, so please feel free to ask questions as we go. We have disabled the chat function, but please use the Q&A function for any questions you might have. It just helps us keep them all in one place. You can upvote somebody else's question if you think it's a great question. Today's session will be recorded and the slides circulated after the session. Thanks to all our speakers for joining us today. Russ, over to you.
Thank you, Beck, and hello, everyone. My little session is going to be, as the heading suggests, looking at the practical tips and pitfalls for farmers, but particularly around general insurances, the insurances that you deal with on a day-to-day basis, so whether it be farm pack or business pack or sizable corporate insurance programs. These are some of the things to keep an eye on. And it's impossible with general insurance. I'm sure you've seen an insurance policy. The wordings are quite substantial, so there's many exclusions and conditions. Can be a lot more complicated than what Bill will talk about shortly with parametrics. So I'll just touch on some of the real high-level things to be aware of, which many of you would know about already, so they're probably just reminders. So looking at the first one, we're talking about underinsurance of assets. You specify a sum insured for your machinery, sheds and farming, and that in the event of a claim, that amount that you've actually specified is going to have a bearing, if it's a sizable claim, on the amount of the payout you're going to get, particularly if you underinsure. So you're expected to insure for very near to within 15% of the replacement value of those items if you insure on a replacement basis, which most policies are. But if you're underinsured, then you'll be required to be a co-insurer or insure your proportion of the loss. So just a quick example, if you had $1 million asset value, of property asset value, improvements I'm talking about. And there was you insured for 500,000 and you had $100,000 storm damage, roof blown off, whatever it is, the insurer would pay 50,000 of that 100,000. And that's what the co-insurance average clause is all about. So that's one to keep a very close watch on. Business interruption coverage for commercial insurance is often misunderstood. You really need to be thinking a fair way ahead when you decide on a sum insured for your commercial coverage for business interruption, which is net profit plus standing charges, or net profit plus cost of production, if you want to look at it that way. And you have to look well in advance, because if you take a policy out at the start of the year, if the loss happened at the end of the insurance period and it was, you look what your future loss is going to be, loss of income, loss of revenue, it's another 12 months after that. So you need to be, when you're taking out the cover, thinking 2 years ahead what your potential gross profit sum insured is going to be. And that needs to take into account seasonal operations along the ways, which can have a big variation on that sum insured. Again, co-insurance would apply there if you're underinsured, so it's important to get the value right. Livestock cover, for those who take livestock cover, it can be quite limited in what the coverage is, can often be just a named perils type cover, where you think you might be covered for disease or transit losses. That mightn't necessarily be the case. You need to be sure you check that coverage out, including government-directed quarantines or slaughter of the animals as a result of infectious diseases. If you expect you have that cover, you probably don't, and it would need to be checked out and insured separately. As I go along, just keep in mind, always the best thing to do for these more complex type of covers is to have the insurance broker, your insurance advisor or agent, give you advice in these areas. Like anything that is an area of specialism, it needs to get the right advice. And finally, crop insurance. If you've got crop cover, it's probably, in most cases, limited to fire and hail type cover, just a named peril. So there's going to be no protection for growing crops for drought or flood or pest damage. So that they are the things that need to be remembered, that they're not part of that cover. And if you're looking to get covers for some of those events, parametric insurance, which Bill will touch on shortly, are the areas you're going to look at. Jumping into liability insurance now, legal liability, keeping in mind it's always legal liability. Every case of negligence is based on its merits, and it's a court that decides ultimately the outcome of whether there is a public liability claim or not. And vital here is to get the business description right. If you have, you'd be expected to be covered for visitors, but for contractors and agritourism, they are areas where you need to describe in the policy wording just to make sure the definition covers your business. Agritourism, for example, you could be asked, are there any contact of third parties with animals? You'd expect to be asked that. But if you're unsure and it doesn't get asked, make sure you mention it in the description, because there might be an exclusion in relation to any contact with animals from third parties. So very important. And the other thing, products liability, anything manufactured or goods sold to third parties, that's what forms part of products liability. Different from public liability, which just covers personal injury and or property damage to third parties. Products covers the same thing, but it's when it arises from the products you sell or manufacture or assemble. And I've seen a policy, a main insurer's policy, just recently looking at a farm, and insurer has said products liability is not covered unless it's specifically mentioned in the policy schedule. So it's pretty common to have public and products together, but obviously in some cases, unless you ask for products liability, then won't have it. So it's vital that you do get that. And the big thing about liability issues, it's not talking about a minor loss potentially. If it's personal injury, you could be talking millions of dollars, which would end your business. So it's vital to get those policy descriptions and making sure the cover is set up right. Finally, the emerging risks and modern considerations. Cyber risks is a big area for consideration. There's so much ag tech and drones, digital platforms. Technology is driving a lot of production these days. So whether it be a cyber event that affects your business and it's business interruption, or through you, the stakeholders, the supply chain is affected, then they are risks that are not covered by general insurance policy, need to have a separate cyber policy. Climate risks impacts, as we know, is frequent extreme changes in weather, not something that the crop cover, your general improvements, cover for improvements would be picked up by most areas under fire and general insurance, but crop is not covered. For flood and drought, those sort of things. And that's something Bill will talk to you a bit about there. So need to be very aware of the how broad your climate cover is that you got under the policy. And finally, contractual risks. If there's any involvement with leasing of land, if you're the host farmer for any renewables type company with CSG or wind farms or solar farms on your land, it's vital that you review the contractual arrangements with the organisation that's installing their installation on your property, because that can roll on to damage to surrounding third-party properties or damage to people who are there, or it might be a total exclusion. So vital that you check through that. The QFF toolkit is very handy in this regard. If you go online to QFF, look up the toolkit and go to the renewables section, you'll be able to see the importance of getting the right advice for these sort of indemnity or hold harmless clauses that if you're not aware of, you could be responsible for third-party losses, which could be extensive. So on that note, I'll pass over, if it's okay, to Michelle, who'll talk a bit about the personal accident side, income protection side. Michelle?
Thanks, Russ. Sorry, Michelle, just before we jump to you, I'll just ask Russ's questions now, if that's okay, just while we're on the topic. Thank you very much, Russ. Good mention of the QFF Renewable Energy Toolkit for growers. There, it is an excellent resource, and we'll make sure that it gets circulated after the webinar with the other resources. So Russ, I just wanted to ask, so when you were talking about the product liability and you were talking about products needing to be listed, is that each specific product or is it categories of products? So if I am a producer that's a wine maker, for example, is wine and associated enough? Or if I was to start making something else like a soap or a hand, would that then have to be listed specifically differently, or are there classifications of products?
Yes, and that's a good job of the broker if he understands the industry, and that's the importance about agricultural brokers or advisors, that they would not so much the soap question, but for the farmers, that they really understand the nuances of what needs to be said. But excuse me, in your example, it depends if it would materially change the underwriter's risk, basically. So if you were to say wine and associated subsidiary products or whatever you want to call it, and that flows on from them, well, they're expected to understand what the exposure is there. But if it's a totally different product, you would need to be telling them about it, because it could change their risk to how it affects third parties. And you could imagine there's all sorts of examples there. So always safer back to notify the underwriter, because they expect to be notified anything that would materially change their risk.
And what might my obligations be with regarding to mitigating my risk when it comes to liability or cyber things like cyber insurance? Is there a chance that my insurer might not cover me if I don't have good risk mitigation in place? You mentioned, interactions with animals by visitors on a farm. If I haven't done a good risk a risk assessment around that, for example, is there a chance that my insurer might not cover me if something happens?
Yeah, that is the case. The expectation of the insurer, it's a policy of utmost good faith at all times, and that's one of the principles of insurance. And that expectation extends to, and I'm sure you'll find an express condition in the policy that any material changes or actions taken by you that could affect the insurance, and that would include poor risk management. If you don't look after things reasonably, they could decline the insurance, and it's on its merits again. It's something you'd have to be realistic. But again, the question is, if I'm storing timber under my house or something like that in a large quantity, well, tell the insurer that you're doing that. If I just don't know why that came out of my head, but I'm just thinking that if you're suddenly thinking, gee, this could affect my insurance, ask the question, because then once the insurer notifies and accepts it in writing, then you've got no exposure. But generally, you're expected to take all reasonable precautions to protect your property against the risks that you're insuring against. Yes.
Great. Thank you. That was excellent. So Michelle, over to you.
Thank you. So as I said before, I've worked in the industry for a long time, and all since '97 has been in the loss of income and death and disability area. So today, just trying to talk about the really exciting things of insurance and go on what we've got here as our points that we've thought things that might mean something to you. So I don't know if you've, like with your insurance, there are two types. There's general advice and there's personal advice. So today, what I'm talking about is general advice, and that means where a broker is they're stating on a product and not taking into consideration your individual requirements or needs. But if you have an advisor, then they would normally be giving you personal advice. So tangible and versus intangible. And it's pretty easy. Tangible, we see them, we think about them, we look at them, we touch them, drive them, all those things. So that type of insurance, it makes sense. We see it. Intangible, it's not front of mind, but that doesn't mean it's not important. So you're important, and that's what we're here to talk about today, and just what might be a pitfall that we're not thinking about. So insuring yourself for loss of income could mean the difference to keeping up with your mortgage and other bills versus having to sell and lose everything that you've worked hard for. So on that, we're talking about just some of the options that are available to you, or hopefully available to you. And one of those is personal accident or income protection insurance. And these words get bandied about quite a lot, and sometimes they mean the same thing, sometimes they don't. So what's the difference? Depending on who you're talking to, as I said, they could mean different insurances. Personal accident normally refers to an insurance product that's purchased from a general insurance market, where income protection can mean that, but it also could mean that it's a life product instead, so which is a bit different. So with a personal accident policy, these normally only provide up to 2 years worth of loss of income, where if it's a life product, it might be able to purchase, you might be able to purchase past that 2-year benefit period. So as I mentioned, with income protection and salary continuance, it can be called as well. This is the difference between the two. If it's a life market policy, normally you're underwritten. So it's very painful in the sense that the applications are not short. The ones that I've seen are between 35 and 40 pages long. So they really are delving into your life and what might have happened in, like, with your health and history. So that's when it comes from a life insurer. The bonus of going through this process, if you go down this path, is that normally once the insurer has reviewed that, you get sign off on what is covered and what is not covered. So it's very clear upfront, right from word go. The duty of disclosure is always there, so make sure that you do answer these correctly, because they will pull that on you if you do not answer your duty of disclosure. So that's something to be mindful of. But the policy coverages for these two different products, they can differ, but as I said, the difference is normally that you're underwritten at the beginning with a life product, where with a general product you may not be underwritten, and there'll be a pre-existing condition or other conditions in there that, should something happen, they will delve into your past history and have a look at what can be covered. So with the policy coverage and other benefits that you can consider, there sometimes like with a personal accident policy, you can get policies that cover accidental death and permanent disability, but it's only from a result of an accident. It will not pay in the general market. It will not pay as a result of an illness. Where if you do buy, and I've got that down a bit further, but if you're looking at the life market, these are different products, and they do sell products for death from any means. So benefits again vary on the loss of income, but they normally pay for 75 or up to 85% of your income. There is the weekly benefit market. It's hard, and I understand for farmers, your income might differ greatly from one year to another. It might fluctuate because of the season, the rain, the weather, what's going on. And so there are some products out there that do offer an agreed value, which allows you to have a number that might be payable, and it doesn't fluctuate so much on the year by year figure, which is probably much kinder than the standard market policy. So why should a farmer or a family-run business consider this type of insurance? Well, we all know that accidents can happen at any time. So by taking out one of these policies, it might mean that financially you can continue living the life that you had pre-injury or illness. So it also means you could have a regular income coming in so that you continue to pay bills and live in your house. I have had normally we sell on a corporate basis, in sense of we sell to a group, and with a group, I had a session where someone did say that if they hadn't had this type of insurance, they would have had to sell their house because they could not pay the mortgage. And it was great to hear that someone has been able to access a policy and continue on. So what about the impact and recovery time? Well, again, this might have a difference to you depending on what happens with what type of illness or accident. But by having some support from a policy, from an income protection policy, the impact on your family would be reduced and much less stressful if you know that you can get better and not have to worry about so much about finding where that income is coming from. So with the superannuation and brokers, and again, it gets all confusing who is doing what and who can do what for you. So what are the options for these? So if you've got superannuation in place, sometimes under superannuation there is an option to cover loss of income for yourself. It just depends on what superannuation product you have, and this would be something that you would need to talk to your advisor on. Also, depending on if you might have a normal everyday insurance broker. They can help you with all sorts of products, and hopefully with a personal accident if it was in the general market, and that's where a broker comes in. If you are looking for a life product, you do need to have an accredited insurance broker or a financial planner where you can speak to about purchasing a loss of income or some of the other products which they and it goes on to this next one, but it goes on to being whether a life or a TPD and those types of policies. So what I've said here is it's again very confusing. There's so many different titles, but to think about it in this way, the life insurance market, they call a life policy. It could mean that it's for death and disability, or it could be because it could have both components of the total permanent disablement and the death benefit, but they just refer to it as the life market and life policies often. In respect to trauma, this can be called critical illness as well. So trauma is a policy that you can purchase that normally has lump sum benefits in the event of something happening in your life. And the policies vary from insurer to insurer and what market that they're obviously selling to. So these do relate to, for example, they might have a list of cancers. If you were diagnosed with a cancer, then there might be a lump sum benefit under a trauma policy. So that's where those sort of policies come in, and they have various benefits. But as I said, it depends on the policy that is purchased. But as I said, they are called critical illness as well. With and TPD again, acronyms and everything like that. Total permanent disablement. That is where you would not be able to. You'd be defined by the doctors that you could not work again, and a total permanent disablement benefit would be paid out. But as I said, you'd need to make sure if you when you want those covers that you speak to your financial advisor about exactly what you're wanting. In the general world, there are, as I said, some similar products. They don't go quite as far as the life benefits. The general world sells accidental death and disability, and they do a permanent total disablement, and it's similar, but again, it must be as a result of an accident and not an illness. So that's where the biggest gap lies. The general market does not cover a disability other than loss of income due to a sickness or illness. So I think I don't know if I've missed anything, but hopefully that gives you some idea of some of the things that talking about personal accident income protection gives to you.
Thank you so much, Michelle. What I'm taking away there is, and I think you've got it in a point there, is regular policy reviews, but also not relying on the title as a description of what the policy may or may not actually cover. And so it's really important to ask that question rather than to assume that, because if you get caught in a situation, the last thing you want to find out is that you're not covered for something that you thought that you were. So I understand, again, the advice that you've given is quite general in nature and not specific. But, if something did change quite significantly, you mentioned some cancers there and things like that. If something did change in my health circumstances, do I need to tell my insurer straight away, or can it wait until the renewal? Like, am I insured for the whole period, sort of no matter what? And again, I guess it depends on the policy, but or do I need to call them knowing that then maybe that wouldn't be covered and then I'm stuck? Or what's the best sort of, approach to take?
Look, my recommendation would be if you've got one of the life policies, like one of the loss of income that's through a life insurer, they're often more, because they've underwritten you already, they go normally with what's in your proposal when you complete your proposal. So if something changes after that, after your cover's accepted, the general advice I would think there is that normally that would be fine, and because as long as you've been open and honest at the beginning, because they will check. But if it happens after the purchase, then you normally got cover for that event because it's been defined as that. With general insurance, if it was a personal accident policy, then more than likely it could change things. My recommendation is if something happens to you and it changes things for you, and you think you may have a claim, I would suggest raising that straight away, because there are time frames on personal accident policies that when from date of event to when you can how long you can claim for that for loss of income. So that's something that's really important to keep in mind. And unfortunately, I see too often where people think, I'll just keep working and put up with this condition, and then they'll exceed the period of time that they've got since being that injury has or event has occurred. So you know, I don't know, you had something quite horrible and you think, oh, I can work for the next 3 months or the next 12 months and then take time. But I would suggest don't. Please just have a talk to your insurance broker about what you need to do and go forward from there.
Thanks so much. And we're also seeing sort of psychosocial and mental health of, management of employees and assistance for employees becoming increasingly, front of mind in the workplace. How do things like employee assistance programs tend to kind of dovetail in with types of insurance? Are they, that kind of proactive approach to managing, because often your staff are your family as well in an agribusiness. Is that something that the insurance industry tends to kind of support? I would imagine, trying to take those proactive approaches towards supporting staff.
Definitely. I think any help you can get, and especially EAPs, because they offer however many times that you can visit and chat to them, I think they're really worth it. And I think insurance brokers and insurers will recommend reaching out and taking that on and using that system, because it certainly can help with how you might tackle an event. So I think it can help. And going on that, I think, as I just said before, early intervention, especially with life insurers, is something that's key. So they would definitely encourage EAP usage.
Yeah, great. Thank you. Be open and transparent and have the conversation, I guess, and try and be as proactive as possible is key to that. Thanks so much, Michelle.
No problem.
Last but certainly not least, Bill, we are excited to hear from you about something very different in parametrics.
Thanks, Beck. Can you hear me? Is everything okay?
Yeah, sure can.
All right. So just dovetailing into the rest of what Michelle and Russell have already been presenting to everyone, what I'd really like to have a chat to everyone today about is not so much a parametric product as such, but rather just how you can keep in the back of your mind how best to use them and knowing when to use them. So it all boils down to data at the end of the day, and this is something I will elaborate on a little bit later on. But the key thing and the key message I really want you to, that I need you to know and to take away from today is no true parametric product actually exists until you've created it. So it is a lot to do with the relationship between yourself, the condition you're in, the insurer who's going to actually be providing the capacity and creating the structure for you. And thirdly, it will be that independent data source that you can both independently lean on, so that way you have a very independent trust point. And that way you'll know that when the data says X, you will be paid Y, no questions asked. If we can move to that next slide, please, Beck. So Beck would have already covered this perhaps in previous seminars, but I just wanted to just touch base on what the difference between an insurance product and a parametric product is. So the insurance product really comes down to you have an agreed set of conditions. Once an event has taken place, a loss adjuster will be appointed. They come out to your property. They will have a look at what has gone wrong. They will quantify how much you're going to get paid, and then eventually the payment will be made by the claims team. The shortcutting that point really comes back to where a parametric is. It doesn't actually sit on the material damage of the product, but it actually relies solely on the data itself. So an example would be flood, for example. If you had a flood based on rainfall, you would say once it's achieved a certain element of rainfall, you know that with a parametric product, it will pay. With an insurance product, the event has to have taken place, the adjuster will come out and they'll sort it out for you. So with the parametric, it pays out very, very fast, and that becomes a self-managed process as opposed to an insurance product, which is a long process. So depending on where your need is, you might want to create a product where you can get a lot of money fast to cover a very specific set of events. And that's why you start to use them specifically for your needs. Okay, thanks, Beck. Can we move to the next slide? So when would be a good time for you guys to think about whether if you need to use a parametric or product or not? Ultimately, it's going to come down to that initial conversation that you're having with your insurance broker. And Michelle and Russell have both really pointed out a lot about having a chat to your broker about your specific set of needs. I like to say that insurance products are maybe the worst jigsaw puzzle on planet Earth, and you really need that expertise of someone who does know how to bring out products, how to join them together, and then how to avoid gaps as best as possible. But ultimately, and as best as they can do their job, there will be gaps. There will be elements of cover within insurance products that aren't able to be covered. There will also be gaps in limitations and sublimits within that. And then there may just be entirely impossible things that can be covered, like that can't be covered due to just basis risk. But this will all form part of the discussion in the first place. So if you're into a position where you don't have the limit or the excess, you need to push the excess up to make it affordable, or you're looking at you need a specific amount of money like to pay staff or anything like that, or just to generally smooth economic volatility, then that's where a parametric product is perfect for you. Next slide, please, Beck. So rather than talk about agriculture specifically, I think it's a lot better just to talk about the concept of what it involves. And really, if you keep in mind with what does work and what doesn't work, then it will help frame up the conversation that you need to have with your broker. So ultimately, what does work is it's going to be understanding the peril and how it actually impacts you. Is it going to be rain? Is it going to be wind? Is it going to be temperature? And then understanding about has there been a historical experience previously that you can draw on as an example to discuss. That puts you into a strong position to say, this has happened before, this is how severe it was, and this is how much that we lost. And from there, it actually gives you the ability to put a structure together. If it happens again, you start looking at the frequency and you'll be able to come up with a price very, very quickly. So keeping in mind also with that, it's what doesn't work. Russ actually pointed out before in one of his initial slides to do with the crops. It is about fire and hail and things, but if you can't get frost or you can't get flood or pestilence is a good example where you can't create a parametric product. With temperature and frost, for example, you can go back and you can see whether the data has occurred before, how severe it has been, and what you need to do. With pest, there isn't actually a lot of recorded data, so you need to be able to figure out if it's going to be available, and also if the data that is available, does it actually correlate with the example that you're trying to bring to us. The lack of detail and understanding is also problematic. A lot of people come to us and say, can you create a parametric product with this? I'm like, probably, but we need to understand from your perspective and the story that you can tell about how it's going to react and how it's going to perform. Because the last thing we really want to do is create a product that didn't work the way that you thought it would. The last thing is about the inevitable. The data is already there. The data will drive the price. And so thinking that creating, for example, a parametric product on hot days in summer, well, yep, it's going to happen. And therefore, it will be incredibly expensive. So you need to be able to look at that distant, catastrophic level and then work your way back to create the best product that suits for you. Yeah, the next slide, please, Beck. Okay, so this is an example that I really wanted to bring up, not so much in the terms of agriculture, but to really highlight the fact that weather events affect everybody differently, but it's actually going to be the same data at the end of the day. So whether if you're an agriculture farm where you're talking about too much rainfall that's occurred that's prevented harvest or downgraded the quality of the crop that you've got, or if you're trying to build a football stadium in California, it's the same data set that you would look at. It's just to do with that application. And structure will then vary on how it's going to work. So in this particular instance, what we've got here is a construction event that was taking place. And over the period of the months that they needed, the strike is what they say 3 inches. So during the construction period, they would be able to handle 3 inches of rainfall a month. But once it starts to go over that, then you're talking about construction delays. And they start to incur additional costs that can be part of that. So then the structure will then come down to how much rain is over it and how much are you going to get paid every time that inch or 2 inches has actually occurred. And this will dictate the premiums and the limits that are available to you. If you convert that back into agriculture, it's exactly the same thing. You would just be looking at crop, say cotton, for example, and you may have a limitation of rainfall downgrade. But as soon as you say, all right, that isn't going to work for us, we need more than this, there is no problem with having a parametric product that runs parallel with a traditional product, because ultimately the traditional product works on the actual event and the damage of the product, and the parametric runs on the data. So once the rainfall exceeds X, you can start to be paid immediately into your crop, and that would offset the limit that you have and provide a little bit further income protection. Okay, next slide, please, Beck. The data matching is by far the single most critical point of the parametric products. We can talk about theoretical products, how we're going to put it together, but ultimately, is it going to suit you? Is it going to be what you need? And is the data going to react and respond the moment that you need it to? So sometimes these products can be very slow to put together, because you do need to make sure with enough historical events that it will actually occur again into the future. And one of the things that we do look at is that correlation versus causation. A good example of that is you might have a weather station that's close to you, an event that has occurred, say, with rainfall, but when you look at where the weather system has moved in, it might have just simply been a coincidence that it happened to be there or not. You then tend to move to different types of weather data sources that you can get, and things that will represent your experience exactly. The last thing you really need is any sort of false positives, and you need to have a lot of confidence that the product has been created correctly for you. So the last slide that I've got for you is just to further put on that causation versus correlation. And there's a few examples here where shark attacks correlate with ice cream consumption. Not really. The fact that people go to the beach when it's hot, and therefore they get attacked by sharks. Another example is Nicolas Cage may make more movies, and at the same time more people die in swimming pools. But that's not because Nicolas Cage made more movies. And therefore the same thing with the temperature. You need to make sure that you're maxing it up and putting all this data together. So when you are talking to your broker, have a bit of patience with the insurer themselves. There's a lot of effort that goes into making sure that that data will fit with your product specifically, and we'll tailor the product to suit your needs precisely and exactly. All right, thank you. Oh, there's the last one. I didn't realize that slide was here. If you need to know about
one more.
Yeah, sorry. This slide in particular is just going to show you all those little blue dots. These are all the bomb weather point stations that are available all around Australia. They capture all sorts of data. And then from there, we can also move into what we call gridded data. So if you're in, say, the central Western Australian area, you can actually grid and interpolate the data in between. You can still create a very reliable product based on your experience.
Thank you, Bill.
Thank you.
So you did talk about it a little bit there, in terms of, making sure that you're, as a client, you come to the insurer with a really good, deep understanding of your risk.
Yeah. So
can you talk a bit more about risk, the concept of risk layering, when you're structuring a product like parametrics, and how, that risk mitigation piece, that ability to, in the construction example you gave, withstand that first 3 inches of rain, so that then you're only insuring your top level risk, to build a more specific product, and the implications of that for the cost of the insurance.
That's true. So the thing is that when you've got your traditional product in place, and you're looking at that limitation, if you're looking at like a sub-limit that's in there for whatever that happens to be, the parametric product can run in parallel with your existing product, and triggering under a set of events, it will cut. So you'll have like a sub-limit of, say, $500,000, but the risk itself is worth, say, $2 million. So you'd be looking at triggering on a data point a parametric product that will pay out the additional 1.5 million, and then you just pay the additional premium for that event. That way, when the traditional product responds, it will go in, and they will assess, they will work out how much of that $500,000 goes to you, and at the same time, when the data point is met, then you'll get paid the $1.5 million separately. And that way you get close to your $2 million just by addressing the shortfall in the product.
But it might also be, my understanding is it could also be the physical mitigation piece, right? Like the building of the resilience in your business so that you're not actually trying to insure either through a general product or a parametric product, the whole risk, because that's when premiums become very expensive.
They do, yes. But it's also a bit of a misconception also to do with parametric products. The whole idea is not really to replace a traditional insurance product, but it's actually just supposed to complement it and run alongside. And therefore, that's where you can actually use them to help smooth out that economic volatility. If you are using them to replace a product entirely, you're leaving yourself a little bit exposed in that a data point may occur and then you may or you may not get paid, but it doesn't always correlate precisely with what happened on the field. And this is where you have the benefit of a traditional product where the loss adjuster can come out and absolutely quantify the event. So you don't want to completely replace a traditional product with a parametric unless it just absolutely doesn't exist and you don't have any other option around that.
Yeah, excellent. There's also been quite an expansion in the ways that parametrics can be structured in recent years, hasn't there too? Like initially we were kind of very much looking at, sort of cat in a box type insurances where it was kind of like, very broad thresholds, like categories of cyclone, for example. Whereas now, as you mentioned, it might be frost days, but it could be frost days at a particular phenological time frame for a crop, right? Rather than, so you're actually not insuring for 12 months under a parametric product necessarily, are you? You could be insuring for a very finite high risk period in your business.
Correct. Yes, you can do anything from 3 months to 3 years. So basically, if you're talking about a specific weather event during your business cycle, then the shorter period would suit you very well. But if you're talking about something that's a little bit more catastrophic, whether if it's flood or it's frost or it's drought, for example, you might want to try and smooth that risk out over 3 or 4 years. And that way you're compelled to go into it over 3 and 4 years, but that will make it a little bit more affordable, paying for it year on year. Because otherwise, the year that it's inevitable, you can't afford it. But in the year that you don't need it, you typically don't buy it either.
Thank you very much. Now, hang on, we've got a couple of questions. Neil, I can see your hand up, so I'll come to you in a second if I can figure out how to turn your microphone off. But we also have a question from Fiona. She asks, are there examples of parametric products for public liability, or are they mostly for natural peril?
It's a good question. Not for public liability, only because the nature of public liability can extend over very long periods of time, and where a parametric product is supposed to be what you call in the industry short tail. You want to be able to start a product and you want to be able to finish it within a certain amount. You don't want to be 5 or 6 years down the track and then find out, this is actually related to something back there. So that's the main reason you tend to separate the two. But in saying that, the type of data that is there doesn't mean that it's not going to be able to create the product. Satellites are really getting used a lot more these days. So fire is one of the big ones where we're not actually using your temperature or your weather, but you are actually looking at a burn scar on the ground. Floods have got a lot of mobility that is happening right now, where it's not just working on a rainfall basis, but you can actually use a reflection off the surface and you're creating like a visual map of the flood area, but it's not capturing depth so well either. So there's a lot of new ways and a lot of new technology that's out there. So I would say always keep that dialogue open, and then when you can talk about it, you can talk about what data is out there available at the moment, and if it is going to suit you, and if the product can be created, by all means, I don't see why not. But yes, ultimately, it is all to do with the weather.
Yeah, and that's just to keep in mind there, liability could come through to weather, but historically, liability policies are based on the merits of the court, and so the variability of those can go any which way, as we all know, and therefore the history that sits behind, as Bill talked about before, it's all about the data. So just pure liability type parametrics based on an index would be a challenge. But if it can be some way related to weather, and then there would be an index that could be worked out, then there's potential for it there. Yes.
Now, I believe, Neil, you should be able to turn off your mic and ask your question.
I actually just put it into the Q&A. So I don't know if you've approved that, but sorry, the question was around, I guess, the penetration of parametric insurance products into agriculture. I'm aware, and I thank Russ for his getting back to me over the years around some examples from Australia. But I just wonder how many actual policies have been written, and is it a really good example from a developed country context around a really successful agriculture parametric product? And if so, what is it? Can you share it with us, please?
Complex question, so ask for a complex answer, but thank you. I will say that it's parametrics in Australia in particular are still within their infancy. A lot of the work that they do overseas in Europe, for example, it's quite expansive. I can't tell you by number how many there is, but you're talking into the hundreds of millions of dollars in premium in Northern Europe to do with parametric policies alone. With Australia, it's still a matter of just trying to work it out. The biggest problem that we really face in Australia is we probably have more severe and more volatile weather than anywhere else on the planet. So it's not the fact that we're not able to write these things, but you're talking about a basis risk problem. People are seeing the fact that they do have an issue here, but sometimes it's just an unaffordable thing, and other things it's just a little bit more to do with the structure, which is why I kind of draw back on the fact you don't want to replace entire traditional products with it. You just want something that will smooth out that economic volatility and something that's going to run concurrently with your existing program. And that way, when it does or it doesn't trigger, it doesn't hurt you so much. But normally, on the average, over the years, it will smooth its way through.
So just can you give an example? Sorry, can you just give an example of those from Europe? What's an example like? Is it around rainfall, high temperature? What crops are involved?
Yeah.
Sorry.
The temperature's a good one over in Europe. In temperature with the crops, it's never quite as severe, but the years are a little less predictable than what they are here. When we have very strong fluctuations in our Enso cycle, and not so much in Europe. So for them, drought cover, it doesn't hit as widespread as what it does here in Australia. For us, when we get a drought, we get it pretty much all over the whole country, whereas the smaller independent countries are affected more by the topography of the mountain ranges and whatever it happens to be at the time. So therefore, you can isolate those down a little bit further. Therefore, the drought impact is less, and so therefore a lower rainfall event is a little bit more smoother and easier to build into a parametric system in Europe than it is in Australia.
Thank you very much.
And Neil, just to add a quick point on what Bill's very familiar with as well, is the work we're doing with modelling, modelled parametrics, if we can put it that way. We've worked with CSIRO and APSIM on a modelled outcome for wheat yield, where and that's right across Australia. So a farmer nominates a yield goal, potentially less a yield gap, if you're familiar with the yield gap, and then decides that's what his ultimate is. But anything, let's say, within range, a certain percentage of that he doesn't get as a yield, then that would really cause his farm a great problem. So he wants to ensure below that trigger level, and the payment is made based on the modelled outcome for the last 40 years using the soil type for that particular farm, for that paddock, right down to paddock level, as you know, APSIM can do, and relating that to the weather perils that have occurred in the last 12 months and what is equating that to the last 40 years perils. And based on that, whether a loss in yield would have occurred based on that information, the payout is made. So the same principle, an immediate payout based on weather, but not on the actual BOM reading, even though BOM takes into account that last 12 months and all the 40 years before it, what the payout would have, the model shows as the payout would have been based on that last particular year, looking at the previous 40 years, if you know what I mean.
Yeah,
so
using
that
a well-tested model too, isn't it?
Yeah, exactly. It's globally tested.
Is around horticulture. I wonder, high temperatures can cause big significant failures in vegetable crops, but I wonder about the penetration of parametric insurance in horticulture. I haven't heard any in Australia, but wondered whether that those policies have been written elsewhere. Anyhow, enough from me.
Yep.
No,
Epsom have done wheat so far. CSO have done wheat and grains generally, wheat particularly, and looking at cotton, but haven't gone as far, and sugarcane as well. It's the other area they've done in that. But at the moment, yep, it's a bit limited, but it could be a thing of the future. That's the thing, Neil.
Yeah, and Neil, the other thing is just bring up the conversation, have a chat. You can look at those planting dates. You can always go to those satellites and really start to tailor something up that's a little bit more bespoke for you. And then that way you can either see if it does or it doesn't work. We're happy to talk to you about like why that basis risk is affecting the premium in one way, or why we would suggest to restructure it another. It doesn't always suit at the same time, but it is always worth the exercise to go through.
Yeah, I hadn't considered that basis risk question which you raised, which I think is really interesting, fundamental to the issue to some extent. Thanks.
Yep. Yeah, that's it. Because sometimes we don't know ourselves until we start digging into the data, and you're like, oh wow, actually that happens quite a lot.
Thanks, team. We can always rely on Neil to ask a scintillating question that sparks conversation.
Call me Doc.
I think that's very much, QFF's perspective and interest in parametrics over the years, as well as, insurance in general, is it's a scalpel, not a sledgehammer, parametrics. And you've got to make sure that, as we've discussed today, you structure it, you have the conversation. It's not going to work for everybody, but generally we try to talk about it working for the risks that keep you up at night. So it's not for every risk. It's for the risks that, you can't, handle if you're ongoing. It's the sorts of things that, your business couldn't offset or couldn't survive if it was to happen. But yes, use it like a scalpel, not a sledgehammer.
Yep.
All right. Well, I think that brings us to the end of our webinar today. I don't think that we have any further questions. So we will leave it at that. As I mentioned at the start, the recording from today will be circulated around afterwards, along with the contact details of our presenters today. So if anybody's got any further questions that they think of afterwards, we will you're more than welcome to get in contact. Thanks again, everybody, and have a good afternoon.
Thanks, guys.
Thank you.
Thanks, everyone. Bye-bye.
Should have said